You win. As the host, I feel obligated to jump in.
Bam!
What's up, brother?
What up, old boy?
Mortgage Geek is in the house, ladies and gentlemen. He is our go-to here for all things mortgage. Now, especially yesterday, like
I'll go to like dance moves, like
oh yeah, backflips, drag,
backflips, drag, cycling, drag. Wait, there's too much drag here. Dude, that video went bonkers.
Crazy. His makeup tutorial video. If you don't like Sean K and the Mortgage Geek on Facebook, definitely check this out. And look at the most recent video, which is going crazy. Still to this day, he comments every single day, being shared every single day. Hilarious.
240,000 views so far in 7 weeks.
Yeah, that's pretty impressive.
That's good, right?
And it's one of those things that's a little bit outside of my scope of understanding. Yeah. And then I just saw all the women who see it are like, this is crazy hilarious. So yesterday, kind of not necessarily out of the blue, but definitely a big down day in the stock market. The Dow Jones was down 780 points, which is a lot. And the S&P was down big. The NASDAQ was down huge. When I see days like that, I immediately go, okay, look at the bond market.
Yeah.
And what's going on in the bond market, and our mortgage rates going down as a result of it.
Absolutely.
Does the market move that fast on the mortgage side?
No, not anymore. Not like it used to. People are a little bit. The banks are a little bit more hesitant these days, so they don't just like, they came down to 1.77, which is crazy, right? It broke 2 and by a long shot, and everyone was like, "Holy moly!" Like, I think by the end of the day, it was like 36 or 39 basis points up. So, it was. But we didn't actually see that much change in like the rate sheet price, on the actual pricing. So we'll probably see a little bit more today. If it stays flat, we'll see a little bit more tomorrow. So they don't just like all of a sudden just, turn on the faucet and just slam the interest rates and allow just like the flooding of locks to come through, because banks also have to make sure that when they're taking their placement that on their hedge that they are covering it. They don't know what the next day is going to be. Like if it went back up, then, hey, they made the wrong bet. So it's a little bit more technical, I would say, in the hands of the loan officers today compared to like the old days of like just rate sheet pricing.
Right.
They would just send out a rate sheet. There's so much time that they could make adjustments, but everyone's really attached to almost like live pricing where. So I think it's a little bit hesitant. That is not a scientific reason. That is just something that I believe to be true.
It seems to make sense. So you're saying we gained a little ground yesterday, but not as much as maybe we could have.
Yeah.
If they were, so we don't know if the secondary market totally believes yet that this is a big
here
move,
to stay,
long term.
Correct.
And so they have to say, all right, well, we have to honor these locks over the course of 30 or 45 days. So we don't want to just pour all the locks into one day. And if they believe that it was going to continue, maybe they would have brought him down more.
Absolutely.
But there's still uncertainty there.
They're just going to let it play out a little bit, see if it like goes back up or kind of. They're just a little bit hesitant just by then just going up and down because then you get a lot of locks and then you have a bunch of renegotiations. Like if you stay high, people are locking it. It's really, really costly to the bank to do a renegotiation, and then people are like, oh my gosh, we have to renegotiate. So there's a lot of more catastrophic things that can happen on the banking side if they just were playing the game of like, up and down and following the market exactly. So I think that they just try to stay a little bit more even.
Yeah, a little more even keel makes sense. Today, the 10-year is up 0.2 of a basis point. So not a lot, pretty much flat is basically what we would call that.
I mean, we might just see better pricing just because we didn't get it all yesterday.
Yeah. But we might see better pricing today as a result. It's really interesting when that happens because there's a refi boom going on right now, a huge refi boom going on. People are doing tremendous amounts of business. I know this is something we wanted to talk about, like, finding those borrowers. How do you get the message out to people and let them know that, hey, this is an opportunity right now. You may have bought your house a year ago or 2 years ago or 3 years ago, who knows? Yeah. Maybe even 6 months ago.
Yeah.
Rates were higher. They were just higher than they are right now.
They are. I mean, they were just quite a bit higher. People that locked in closed in December are reaching out to me right now. And the difference of rate is like 1%.
Really?
I mean, it's a large difference.
Yeah. You take that to the bank.
Yeah.
1%?
Now, VA has that new rule, right? That, which is cool. It really just kind of protects everybody involved. But when you're doing a IRRRL or a cash out refinance for the first time after you purchase or after you close the transaction, you have to actually, now it's 210 days past the date that your first payment cleared your account.
Gotcha. 210
Not
days.
just 6 months. Then people see what was happening was loan officers. See, loan officers, when you do things that hurt other people, you're hurting the other bank. So that's why they put in stricter laws. So just stop doing it, please. On the other, like on the FHA and conventional, they still do them. EPOs exist. That's catastrophic to banks or to smaller mortgage banks. So stop
EPOs
doing
meaning
it, please.
early payoffs.
Early payoff. So the borrower doesn't. The borrower can refinance after 2 months, 3 months, 4 months. It doesn't make any difference. But when a mortgage bank or, broker or, anyone that is funding the loan, and if they end up selling it, they're on the hook for like 6 months after the sale, 180 days. So what happens if it gets paid off before? There's a penalty to the person that funded your loan. And the borrower's like, well, I don't care. I'm like, well, they funded your loan. Give them the respect of, doing that. It's really the loan officers going like, hey, it's not bad, and you should do it. You should always look out for everybody.
Yeah.
So I just want to give that plug.
Yeah, I think I agree 100%. And also, if you're really refinancing 2 or 3 months after getting a loan, really take a look at what's going on there. What has really happened that it's moved, the market has moved that much, and is there a shift in the marketplace taking place? And if it is, maybe you're pulling the trigger too fast. Maybe
Well, here's
you
where we
should back up off a bit.
We see it a lot when the borrowers take, hey, I want to increase my interest rate to get a lump sum credit. So then they get a credit from the bank who funded their loan. They're all like, oh my gosh, this is wonderful. Thank you so much. And then they turn around and just screw that bank because then they go and refinance. So the bank who just gave them the money just gets double whapped because now they have a penalty. Oof. They have to pay all their employees. They have to pay the loan officer. So, yeah, we're seeing that more and more. It's like, you guys look out for each other, please. Tell the borrowers, educate the consumers that, yes, it is a benefit, but just hold off until there's no penalty because the person did go out of their way. They did help you. They did give you a credit. They gave you money up front.
And beyond that, I mean, I'd say even just look at, well, what is this really beneficial? If rates go down, in other words, are you refinancing for 1/4% or 1/8 or something like that?
Yeah, don't do that either.
Especially a couple months in, give it a little breathing room, because if you refinance once at 1/4 and then it goes down another quarter, you refi again. Now you have 2 refis to get a 0.5 point. Whereas, as you said, people who waited since December got a full percentage point.
Yeah, it's amazing. Yeah.
So I think there's something to be said that when the market shifts,
happy.
yeah, be careful but be tactful. Call the Mortgage Geek, chat about it, have a conversation, see what makes sense for you, and don't necessarily expect that to do a refinance every 1/4% on the way down. Like that's not wise.
And LOs out there, you guys, if I pull that property profile and see that they just, I won't do the refi because I would hate for it to be on my side. So I'm starting that trend, going like, not going to EPO you.
That's awesome.
One of my friends EPO'd me.
Oh.
And he knew it.
Really?
Yeah.
He EPO'd you on purpose?
I guess he needed a closed transaction.
Wow.
Yeah.
Wow. Well,
it happens.
what can you do?
I can't do anything.
You can't control what other people do. You can only control what you do.
Yeah, exactly.
That's why you have to do the right thing. Other people are going to do what they're going to do.
Always do the right thing.
Just do the right thing. That's all you have to do. It's not rocket science. Now, what's also interesting is what's happening in the real estate market right now. So we're kind of back in that weird mode we were in. It was last year, I believe it was like that, but and a little bit maybe at the beginning of this year. But that weird mode where you've got good inventory flying off the shelf. You've got inventory that's not perfect sitting or going stagnant. There's a lot of activity. There's transactions taking place, but you can't really define it as a hot market. Some pockets are still hot. Some are cold and getting colder. higher price points have really slowed down. We're kind of back at that
unknown
jigsaw.
area.
Yeah, it's
Yeah.
like the gray area.
So I did actually pull some. I was just kind of doing some brief research. I don't know if this. I mean, there's always a bunch of different information out there, but this is just kind of like a general. So refinance, of course, up 34%. 34% increase in refinance applications. That's great. It's actually great for the economy, great for the homeowners, lowering those payments or getting cash out and lowering their payments. Purchase transactions down 2%. San Diego closed 3,687 transactions or something, 3,600 and change transactions in the month of June, which is the lowest June in 8 years.
Really?
Yeah.
That's interesting.
Interesting, right?
Very interesting, especially with the low rate environment like this.
Yeah.
So low number of transactions, in the past, we would attribute that to a low inventory count.
Correct. But there's a
lot of inventory.
I just looked before I came over here. I was just like pulling up, what's happening in Rancho Santa Fe. I never look at those, because their price points are just crazy and those houses are bonkers. And I just plugged in just like a decent, Rancho Santa Fe number, and there was like 64 listings. I was like, geez, it got some inventory.
That higher price point, there's a lot of inventory. Surprisingly, though, I just did this search on Friday.
Okay.
For 3-bedroom houses in San Diego County, under 500,000, with a pool. Must have a pool.
Is there anything?
108.
Whoa.
108 homes came up.
Under 500.
Under 500.
Single family.
Single family, detached, with a pool, 108. So, and then I did the 4-bedroom filter, and there was like 60 or something like that. So it's like 4-bedroom with a pool, under 500,000. There's 60 homes.
That's a lot.
To me, it's great. Now, I'm not saying that everyone wants a house with a pool, but it is summertime.
Yeah.
And you would think that if there was going to be any time of year where you would be, have a low inventory situation, houses with pools that are low priced, this would be it. Not the case.
Yeah.
So it's super interesting to notice that. I think a lot of people also get it in their head, certain things about the market that aren't true. And if you believe it to be true and you act as though it's true, then you're essentially manifesting your own reality. It's a self-fulfilling prophecy.
Absolutely. Yes.
So, take a look at what's actually out there. Do some searching on your own. Hopefully your agent isn't causing you to rely completely on you. That's one thing that I think is a real bummer. When I talk to
Agent
buyers.
needs to be selling.
The agents have got to find properties for people.
They got to be selling.
Yeah.
They're not, you guys are, not saying that you all are, but sometimes, consumers that we speak with, are just like, I'm willing to switch over to this other agent because all they really do is open the door for me. Just don't want to be in that classification.
Yeah. I think it's, with the technology, it's very easy to say, all right, we'll just take a look and see what's online. Let us know what you like.
Yeah.
But with regard to the agent, making the customer happy, making the buyer happy, performing their duties, that the buyer will then call them, because the key thing is we'll then call you later when they're ready to sell, right? You want them to do that. You got to find them the house. If they find it on their own, buyers do not like that. They do not like it. They feel like they're overpaying. They feel like
totally
that the agent hasn't earned the money.
I want to come in underpriced. It's like
that's just the way they feel. In fact, we just spoke with someone yesterday who felt that exact same way. She said, I found the house that we're buying. I don't know why we should have to pay any commission to anybody. We found it. They didn't do anything. So finding the homes is super important from an agent standpoint. I implore agents out there who might be watching this, really make sure you're the one who's finding the houses. Make sure you're the one who's delivering them to the buyers, because they really see that as valuable. They actually see that as your job in the situation, and they want to see you do that. And a lot of buyers don't have time to scour the internet. So if their agent isn't sending them anything, they will assume there's nothing for me.
yeah, correct.
There's nothing out there. There must not be anything. We told our agent what we wanted. They said they were on it. We haven't seen anything from them. There must not be anything. And so don't necessarily think that's true. Make sure you take a look, because there's a lot more on the market than you would believe. A lot more than I thought there would be.
Oh yeah, no, the market's great.
100+ homes with 3-bedroom detached with a pool in the dog days of summer right now.
I mean, and the prices are, just on some of like the houses that I've just kind of been looking at, like like you're saying, there's some hot, areas, but there's also some price compression a little bit as well.
Sure. Yeah, absolutely. Well, you're seeing that if you're going to sell your home for top dollar in this market, it had better be turnkey, ready to roll, everything's done.
Smashing.
It has to be everything.
Yeah.
Buyers just won't pull the trigger. They won't. They feel like that it's the top of the market or close to it. They don't want to spend that kind of money unless it's
even
already
if they
done.
have a crazy low interest rate and all that. Like they're kind of past that because like the interest rates have been low for so long, right? So they have to shift over and be like, okay, cool, interest rates are low.
Yeah. The other thing that's interesting about this market is that people are as interested in fixers as they are in turnkey. And I've never seen that happen before, but it is a sign of potentially a market peak or saying, hey, we're into the top end of the market.
We want to add value.
People are thinking that's the only way they can get a deal.
Yeah.
Is if they buy a home that needs to be fixed up. And most people, this is very risky, and I wouldn't recommend doing it unless you have a lot of experience flipping homes or in construction, because there are a lot of things that can come up that you may not know about, you may not understand, you may not realize the expense that's associated with it. So be very, very careful about it. But the interest is most certainly there. Most certainly there.
Oh, yeah.
Every time a fixer is out there, it gets a ton of activity and a ton of interest.
Even from the end users.
Yeah, absolutely.
Yeah, that's what we're seeing.
No, totally.
I've seen more and more appraisals come back, and I'm like, wait, why are you buying this house?
It's totally cool to make it your own. Like, that's great. And there's so many programs out there now.
This is a shiitake mushroom house. Not good. This thing is falling down.
Actual footage of Sean looking at an appraisal.
That's what I did yesterday. I was like,
Yeah, people want it because Chip and Joanna have made us all believe that it is not that tough to go in and take a piece of crap and make it into something beautiful.
totally.
They have really given us all that kind of hope. And people are into it, and they like it, and they want to make it their own, and they feel like they're getting a better value that way. And it's possibly true. I'm not saying it's not. I'm not saying you can't go buy a fixer and get equity because you bought a fixer. I'm not saying you can't. But I know this. In San Diego, there's a lot of flippers, and there's more flippers here than anywhere probably in the world, in any marketplace. It's unbelievable the amount of hedge funds, the huge money that is funneling in here so that flippers can buy properties and securitize properties is crazy. So
There's a lot of building going on.
yeah, it's
Remodeling.
It's nuts.
Say. Yeah.
So you are.
Because we don't have places to do new builds.
That's exactly right.
We don't have the area. Like, what are you gonna do? You're out. You're deep.
Yeah.
You're
Fallbrook.
deep Chula Vista. You're deep Fallbrook. You're deep Carmel Valley.
Or way out in Lakeside. There's some
Yeah.
stuff out there.
So that's why the flippers are so crazy. I mean, in other markets, it's like just new build.
That's right.
We just don't have that here.
That's right. And it's
Yeah.
harder to compete in other markets if it's a rehab property, because people will look at it and just go, well, why don't we just buy new construction? We
Yeah,
don't know.
correct.
We don't know what's behind the walls on this one. Let's just get a new
They
one.
love new construction
Love it.
in
They don't
every
have it.
other area.
Yeah, because they have it. Here, it's like, you don't have it. I mean, new here is like a Carmel Valley house that was built in the 80s.
Yeah.
That's like new. It's like, oh, well, this is a new area over here. It kind of is. Because there's a lot of homes that are built in the 20s and 30s, 40s and 50s.
It's crazy.
I love the 50s era homes. That's my favorite, actually. I love the mid-century stuff. 50s and 60s is my
Is
favorite.
that the one story, like, big, huge eaves and
Yeah.
that-
Big
I like that.
rooms,
Yeah.
big bedrooms, had less bedrooms. They were big. They started with some of them with the open concept. It was single story. I just love the setup. There's a lot of little step downs into bigger rooms and stuff just to create separation, but getting rid of the walls. So I love the mid-century stuff. But if you buy a house that was built in the 50s, you have to know what you're getting yourself into.
Absolutely.
There's a lot that could potentially be there. So that's what a lot of the buyers, I think, have been experiencing. The other thing with regard to sellers is that a lot of sellers are in kind of a situation where they go, well, you know what? If we can get this much, then we'll go. Then other sellers, just the few sellers who are like, well, we're leaving San Diego. We're gone.
Yeah.
So sell the place. Whatever it takes.
Too expensive.
Sell it.
Yeah.
How many people have left? I mean, the last 7 out of the last 8 when this listing shows we've done, they've all left California.
Just left California?
Bye-bye. For lots of different reasons. Some of them, it was their own reason of, you know what, we just want to get out of here. Some of it was at a better job opportunity somewhere else. Some of us, we're going to go be closer to family. Some of us, we're going to retire. We're not going to retire here.
Yeah.
I'm going to Arizona.
It's a pretty tough state to retire in because of, especially for that state tax too, Prices are high. I've had a couple bars come here and then they move back.
Yeah. Yeah, it
They're
happens.
just like, well, we tried. Didn't work.
Yeah.
Too expensive. Political. There's some California's
very big in politics.
very big in politics.
No question about that. Taxes are definitely high here. Income taxes,
I mean,
gas.
it's a great place to live, though.
I don't think there's a better place.
San Diego, I even on the way home from Hawaii, I'm going kind of excited to go home.
Yep, every time. That's the one thing I know.
Kind
No
of
matter
excited.
where I travel in the world, every time headed home, it's like, can't wait to get there.
And it's not because I want to sleep in my own bed. It's because I want to enjoy San Diego.
It's because San Diego's amazing. And this is why the prospects, I think, for San Diego real estate long term here are very, very good.
Yeah.
Very, very good. When I say we're at the, potentially at the top or top end of the market, what I'm saying is that for the interim, in the, let's say, short to medium term, we could see prices decline. It's possible. They may not. It could go up and then come down. They could go down and then go up. We don't know. But I think long term, they go up.
Yeah, absolutely. Like, the mountains is not just like this the whole entire time. It has, goes up, goes down, goes up.
So is the San Diego real estate market a mountain?
Yeah. We're climbing the mountain.
What else can we do right now, especially for buyers or homeowners who are looking to refinance? Like, any savvy advice for the people out there right now?
Pick somebody and go with them. Pick somebody and go with them. You can be shopping and shopping. Think that, oh my God, this is such a great deal. At the end of the day, you're just wasting time. If you are going to refinance, the quicker that you can refinance is better because you are re-amortizing your loan. So remember, think about it. Every month that you're sitting there shopping, or every month that you're waiting on possibly it getting a little bit better, yeah, your savings, you could have just blown it on interest. Like, hey, $3,000 on interest, cool. You literally just blew it because you wanted to wait one extra month to start over your 30 year.
And
No one ever thinks about the re-amortization of a loan. Ever.
And the people who do are very adamant about it. But the thing that's really interesting is if you wait for interest rates, which might be the right thing to do. If you're only saving a quarter,
Well, yeah, correct.
then maybe you should wait. Like, so you know what? Okay, let me wait until I get to more like a 0.5%.
But you're saving like a 1.25%. I talked to somebody yesterday. They're saving over 1%. He's like, oh, not sure. I might wait till it gets a little bit better. Like, dude, you've been in your loan for like 8 months.
Now, depending on your loan amount, right? That's the one variable. If you can
This
save
is a higher loan amount.
Okay. If you could save
700.
0.5%, okay. 0.5%, that's usually where you go ahead and pull the trigger.
This is more than 1%.
On
700,000, and you've only been home for 8 months.
Wow.
Pull the trigger.
Yeah, that's when you just go ahead and just do it. And if the rates go lower, then you look at it again.
Correct.
But if you have a percentage point in your pocket, you take that.
On such a short time, you haven't paid enough interest. I mean, what are you going to wait for?
Yeah, you just go ahead and you pull the trigger on that.
Yeah.
But if it's closer, if it's like a quarter point or something like that, you go, you know what? I really want to get to that 0.5 point. That's okay. That makes sense. Yeah, you can wait, but you're going to need to be on top of it.
Absolutely.
And you need to be on top of it. You need to pay attention to it. You need to stay in regular contact with your loan officer, or talk to a loan officer who's going to manage that for you. But you have to be careful because, as the geek said, they don't necessarily price immediately anymore. So based on that, we have to make sure that whenever it is the case that we have a day like yesterday, where the Dow is down huge, where money piled into bonds,
Yeah.
10-year got crushed. I mean, you should be looking at this now and going, all right, well, over the course of the next week or 2 or 3, when is this all going to get priced in? If the 10-year stays right there, maybe you'll start getting a little bit of it each day, and then over the course of 2 weeks, all of a sudden you'll be there.
Great. You asked me what what people should be doing. Reach out, pick somebody, do an application, submit all your paperwork.
Just do it.
Just do it.
Yep.
Start the process.
Yep. If it makes sense,
Start the process.
pull the
Because the worst thing that you could do, I mean, I heard that Bank of America is at 90 days for refinances.
Seriously.
That's what I heard from one of their loan officers. 90 days.
Somebody needs to get over there and
What about? I mean, Wells was at 17 days in underwriting for initial underwrite. Like, turn times are like 45, 60 days, right? So if that's actually happening, then starting the process, the worst thing that you can do is get in, start it, don't lock, rates went up. Or start the process now, they only lock you on 30-day, and then, hey, you have to extend your lock, and you have to do those types of stuff. So those are that can be really costly. So
yeah, makes sense. So
just start the process.
Start the process, and then when you have a rate that you like, that you can
Lock.
lock, pull the trigger.
Yeah.
Great stuff, Geek.
Cool.
Good to see you, my friend. Hey, share this video. Make your friends smarter than everyone else. We'll see you soon.